Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We're here to answer your questions and try to help you with your retirement. Whether you're 20 or already into retirement, a lot of these things will apply. We try to work on, the retirement planning, the investment portion, of course, the tax planning and such too. So feel free to ask questions here during the show if you'd like. You can send them in via the email, asktom@talkmoneywithtom.com. You can put them in the chat here on the channel, and we'll try to answer them live. You can send the emails during the week. Give us a chance to, look at them and such too. So, we put together this channel as an educational resource just to try to help people kind of understand the language of the markets, what to look for within the markets, how to make sure that your, retirement plan is working and all these different areas. And so, we have videos in there about Monte Carlo simulation and Roth conversions, etc. So you can subscribe to the channel, take a look at what's in there, hit the bell button if you want to get notified when we have new things. And of course, if you just want to meet with us, you can do that too. 30-minute appointment with Ethan and I. There's a book appointment button on our website that you can use for this too. So looking forward to being able to answer your questions today. Feel free to start sending those in as we're going here. I am going to start off as usual. The first part of the show here is just to talk about what we saw happening in the stock market this week, right? Kind of a summary for the week. We do our daily videos Monday through Friday. We maybe miss one once in a while, but we cover those days for what happened, and then Friday Monday through Thursday, and then Friday we try to do the summary. All right, so we'll start with our little chart here we've been updating. This actually goes back to 2018, and you can see the pandemic drop in there and the 2022 drop that was from inflation. Right over our heads is the drop that happened, when they announced the tariffs on Liberation Day and such. And markets come back. And so I think that's what's important about this week, actually. First of all, we're having a good day today. And if it closes, at a new all-time high, we made back the money that was lost that one Friday when they announced they were going to increase the tariffs on China because of tariffs, new restrictions that they were trying to put into place for rare earth metals, right? Mm-hmm. So we dropped 2.7%. And so I know that doesn't seem like a big deal, but it actually kind of is, because you never know, especially when you're having these big runs like this. Are we now going to start a downturn? I didn't think so. We talked about that. There's just too much buying momentum that's happening here, and all of these dips look like opportunities to the dip buyers, right? And they're not done. There's enough money out there. And honestly, to see a true top in this type of environment, I think you need more craziness, just personally, just from my experience of looking back. And again, to me, this is a lot like the 95 to 2000 time frame. So if you really study that and see how that motion happened, look at what happened to the NASDAQ. It doubled, went up 100%, in 1998. The NASDAQ's no longer that kind of index, to be honest. Back then it was a lot smaller cap than it is now. But nonetheless, we're still kind of moving along with this. And so getting a positive week like it looks like we're having this week, and hopefully setting a new high today, those are big deals to kind of just say, okay, that dip that we just had was probably temporary. And obviously it was if it keeps going. So the big news that kind of driving the market today is the consumer price index. So this is what they call the headline, top line consumer price index, mm-hmm. which includes energy and food. Then they have another one that they use called core, where they take out energy and food. They actually are both the same. So at this point, hit 3%. Now, this is the last 12 months. So we actually just hit essentially the same inflation rate that we hit back in January, 3%. So, and this is year over year. So we're looking at, September of this year versus September of last year type of thing. Now, this report usually comes out earlier. It's obviously delayed because of the government shutdown. And then, of course, since they fired the head of the BLS, who does all of the, organizes all of this reporting, it just makes you a little nervous about what the real number might be. I think it's probably okay, but anyway, so 3% year over year. You can see it's going up ever since the tariffs were announced. The inflation's going up. The inflation, just looking at the month, so if you look at September of this year versus August of this year, was up 0.3%, which again annualizes out at 3.6%. So that kind of matters too. So the trend is upward. Okay, they just had the consumer sentiment survey that University of Michigan does, and they are projecting as consumers that inflation will hit 4.6% year over year within the next 12 months. And so that's a stat the actual Fed pays attention to, because they think that, if people feel like prices are going up, it changes behavior and they start buying things faster, which can obviously create inflation, right?
And you could kind of see that reflected in earnings reports with a lot of companies, is because if people are, buying things faster than usual because they want to get ahead of the inflation, you can see companies' earnings are going up.
Yeah, that's the weird part about the tariffs so far. We're in the middle of earnings season, right? And we're having the, best earnings season in the last 4 years. Why? What's happening? Well, a lot of it is, I think, whether you're a company or a consumer, you're thinking prices might be going up. I should probably be buying things I need, that I know I'm going to need, try to buy them now if I can, right? And so it stimulates the economy. Makes it look great. So that's kind of interesting how that's happening, because we haven't seen the negative impact of tariffs yet. That's going to be a ways off if it does happen, those type of things. So earnings season has been great. That really helps. And I'm just going to transfer back to here so we can talk about it. So the other piece of CPI, I think that's really important, is just that the expectations that by a lot of different people that are looking at the CPI is that it will get up into the fours, maybe even into the sixes, right? We were hit 9% back, or 7 point something percent back in the 2022, drop.
Yeah, I think core, or not core, but just regular CPI got up to 9, and then core never.
Core didn't quite get there, right? Yeah. So here's the deal. Normally the market would be falling, and normally they'd be lowering rates based on that thought process. That's exactly what happened in 2022. They were raising rates. Sorry, they were raising rates, bringing down the stock market. Stock market dropped 28% in 2022 from its high point, and yet the market went up almost, right away today based on this higher inflation number. It was a little bit less than expected, but the trend is troubling, right? I mean, it's going up, and going back to 4 or 5 or 6% is a big deal.
Yeah, I think the Fed has made it clear that they're willing to give into inflation as long as they can save the job market. Is more important to them.
Well, even more importantly, Chairman Powell's directly said that they feel that this is a one-time inflation bump, and they're going to do everything they can to make that happen. So you just told all the market participants that the Fed is going to backstop kind of the inflation side somehow. I don't know how that happens, but nonetheless. And that they feel, with their 400 economists on staff, that the tariffs are going to be a one-time jump, which theoretically could be true, right? So if all prices jump 5, 6, 7%, and then all of a sudden you would get back down to a lower inflation, kind of in that 2 to 3% range, because, again, tariffs were a one-time deal. The problem with it is the carry-on aspects of it. So it's kind of controversial whether it's a one-time deal or not, because it doesn't make people want more pay, which then means that the companies have to charge more, and you kind of get
create a spiral.
Does create that spiral, which is what happened in the 70s. So, we'll see how that all plays out, but the market likes where inflation is right now, and I think, personally, the market doesn't care, because they're buying into the one time only. And if it truly is one time only, it's probably really damaging to the lower end of the income spectrum, but might not be damaging to the stock market in the end. So anyway, I think that's kind of fascinating when you look at what's going on out there as far as that goes. And so we have some pieces, though, that have changed just in this week also. Oil is up about 7% in a couple of days. Because of the threatened sanctions on the big Russian oil companies. And so one of the biggest drivers of CPI that they just reported was actually gas prices were up 4.1%, from this September to last September. So, that's a big one. Oil's a huge impact area on inflation. It's certainly what drove it in the 70s really, really hard. However, we've not seen any real sustained increases in oil any longer. You have too many places that are kind of cooperating and turning on oil, when they need to, when the prices get higher. And the U.S. is in a totally different spot with oil. We're a net exporter now versus where we were before.
Yeah, and there's speculation that they're going to try and get more oil out of Alaska now.
Yes. So, I suspect that won't become a big issue. And, it was the big fear when the Ukraine war started, and oil went to 130 some dollars a barrel, and it's dropped back into that $70 range. So it's kind of an interesting thing. We've seen China and the U.S. this week start to kind of mellow out some of the wording and stuff, specifically from Trump, just talking about, it's going to be okay, those type of things. Seems like, they're on a better footing heading into their meeting. They meet next Thursday in South Korea. And so it'll be really interesting to see, I think if something good comes out of that meeting, the market could really go, right? Something bad comes out of that meeting and they tend to, get into a farther fight. That it could be a problem. China, in my opinion, has the upper hand here. I'm not sure, what they're going to do with that, because a lot of the things that they can do to cut off things actually will hurt them too. So if you slow down the U.S. by restricting, rare earth metals into the U.S., manufacturing supply chain, that's going to ripple around the world and cause problems for China and what have you too. So it is a good threat. It is a big threat, but it's sort of, shooting yourself in the foot kind of threat if you're not careful. So but they do have it, that and their dominance in pharmaceuticals and all these other things that they've been able to kind of set up that are critical. So it does give them some wherewithal. My hope is that their leverage is enough to actually lower their net tariff, because right now their net tariff is, it's 40%. It's between 7.5% and 50%, but a weighted average of what actually gets exported comes out to 40%.
Yeah, and then each little thing has a different tariff.
That's right.
It's very confusing for everybody.
Yeah, I imagine. But you get that down to, say, 25. I mean, that's a positive impact for the world's markets as a whole. So that was my weird outlook on this situation with China, isn't that we're going to end up with higher tariffs with China. Because of their leverage, we might end up with, at some point in time, if they continue to push that leverage, with some lower a workout with China that isn't at 40%. But I think that's a low probability, but just kind of an interesting outcome, not something, normal, not what you would not expect on a regular basis. So anyway, and so that's it. It was a pretty good week. Going forward, we're going to be watching the regional banks, because we've got some situations where watching those loans, seeing how things go, because they're kind of the canary in the coal mine is all this loan activity that's out there. As far as that goes.
Usually when you see any kind of fraudulent activity or kind of, defaults, that's because the market's, there's pressure on the market from the market.
Yeah. So just real quick summary. This will bottom line kind of what I'm thinking about what's happening with this market. We have severe upside momentum. We have dip buyers that are there ready to go on every dip. We hardly ever even get a chance to get down to a 5% or anything along those lines. And with that momentum, we have rate cuts, that are coming at us, expected for both, next week and in December. And we've got these tailwinds that are just driving this. And while that's happening, and the market is really skyrocketing up, you got all these pieces kind of in the foundation that are kind of falling out, so to speak, and they're going to create potential problems. The narrowness of the market, still the big companies are kind of dominating, the overall thing. The valuations, this is one of the most expensive markets in history, and so there's all of these pieces and everything that you can think of that comes up that's a negative that is kind of chipping away at that foundation. But the foundation is still strong enough for this to catapult itself up for a while longer, like we saw in 2000. But they're just going to keep adding, more and more, cracks to the foundation over time as this thing stretches out. And that's what ultimately. So right now, valuations don't matter, but they will when everybody starts selling off and starts using that as an excuse. So because that's my base case scenarios. We're going to have a big run up here and then come back down in some type of a big drop, sort of like we did in 2000. And, again, as long as you got in early enough, even with the big drop, you probably made some money because the run up came before the drop, which is nice. So I think that's probably where we're going now. We'll see. Okay, good. So that was our breakdown on what we saw happening for the stock market this week, and look forward to kind of going over that again next week. But let's start with some questions that we have coming in.
Should we be concerned how interconnected the AI companies are now with all their different deals? How they're investing in each other, and then the investment comes back in some sort of or buying of processors. Is this just round tripping of the revenue kind of?
Yeah, this is a good question. This came up this week, and actually have a visual for this, and this came from Bloomberg. Because that's it's a good talking point. This is something that's been coming up, which is just, hey, how much is this is real business and how much of this is just the same money kind of floating around and making excitement that gets the stock market going. And they keep announcing all these deals, and in my personal opinion is one of the reasons that these deals are happening. Everybody's trying to get the limited commodity chips. So that's, let's make a partnership with NVIDIA or AMD, or how much was AMD up so much this month?
I think it's up to 55%.
55% this month. Yeah, and that's based on some of the deals that they've announced. So this graphic kind of shows all of these different connections, and Microsoft and Oracle and AMD and NVIDIA there in the middle, is really benefiting. And so, I think it's probably another one of those things that you would look at and say, wow, that's got some potential to create some problems if that stops.
Yeah, it kind of makes a house of cards, and if one card falls, everything else could collapse around it.
Right.
So it becomes like a systematic risk rather than just a single company risk.
That's a good way to look at it. And the problem is, what do you do about it, right? So do you sell your holdings, lighten up your holdings? I mean, this is just one of many things you could point to for why you might want to lighten up your holdings. Yet the market's still going up. We're hitting a new all-time high today. And the market could, eventually this could all fall apart. The house of cards comes apart that they normally do. But the market could be up 50% from there, some crazy number from where we are now before that happens. And so, it's just one of those things to pay attention to. I don't think it's one of those things to react to. It's just piece of the puzzle for where we're going ultimately. And it's one of the things to watch to see if it starts to fall apart. But
yeah, we'll see if there's any like regulatory scrutiny too, because people we'll see how much scrutiny, because there's a lot of deals that are going in between. Like NVIDIA invests in OpenAI, but then OpenAI basically says, hey, we're taking the money and buying chips from you back, right?
Yeah.
Is it basically NVIDIA inflating their own revenue using their own money?
Yeah, exactly right. So that, it could work out great, right? I mean, this could just be the way that you build data centers in the most effective manner, and the fast build outs of these giant centers,
OpenAI doesn't have the money to do these build-outs,
right.
So they need to get some sort of the money to make builds.
Yeah, I saw a headline saying that OpenAI still needed $400 billion, which was some, like that's the combined, revenue source for a whole bunch of different countries. So it's a big dollar amount. But anyway, that's a good question. I think that, it is a concern. There's lots of concerns. It's just one of them. I wouldn't be trading on it per se. I'd be watching it and just seeing how it plays out. Unfortunately, I don't know that there'll be a lot of regulatory issues here, with this particular administration. I think, this is more of a freewheeling, dealing kind of scenario that's going on. Even the government, we saw quantum computer stocks go crazy this week after some, talk about how the government could get involved in some of those companies, like they've gotten involved with Intel and one of that lithium company that they.
Yeah, I think they bought I think they've up to 4 or 5 stakes in different lithium companies or rare earth metal companies. So they're definitely looking to. I think it's fine if you think it's a mission critical or like a resource to have investment, and it takes money to set up these industries.
Yeah, I think it'll be a really interesting experiment because, it's not capitalism, right? It's not that we've always practiced capitalism. We bailed out GM, and true capitalism would have let all these companies go out because it's sort of like a forest fire, cleaning out things, and then regrowing, companies maybe that are more efficient than GM, right? So once you start getting the country investing in some of these stocks, what does that mean and how does that play out? My gut feel at the moment is it's like it's okay. Like you said, some of these things are critical. Like the Intel thing, they're the only U.S. manufacturer, potential manufacturer of some of these chips, and so not letting them fail and helping them to survive. You know, it's no different. I mean, we've done it with farmers. We subsidize crops, and there's all so it's
Yeah.
capitalism in its purest sense hasn't been happening for a long time. But this is just another step in that kind of central planning scenario. Very small, so but we'll see. Yeah, it's an interesting part. All right, what's our next question?
So, what is the difference between or the QQQ fund and then the QQQM fund? They're both kind of Nasdaq 100 index funds, and what's the use case for each of them?
Yeah, so first of all, it's the top 100 stocks in size that is on the Nasdaq, which has what 1,000 stocks,
Yeah.
I believe, right? And so, this is the big tech companies, because back in the 80s, that was the big place you listed your company, was on the Nasdaq, because it was not, it was computer operated, versus the floor for the, so anyway, QQQs have been around for a long time, and the actual QQQ symbol is essentially a mutual fund. They call it a trust, but for me, just thinking about it, so it's going to pay out capital gains every year if they have some from some of their trading as they move a big stock off or one on or whatever. And then whereas the QQQM is an ETF.
Yeah,
Right?
so with ETFs, most of the time, it's more just a tax efficient, so they don't pass as many capital gains through to you until you actually realize those gains.
Right.
So there's tax efficiency, and one thing is the volume and what type of trading are you doing? Because with QQQ, you have a lot of options written for them. There's a lot of liquidity. It's a lot of people for day trading or kind of, day trading or any
Or
kind of
options trading in
Yeah.
general, right?
anything with volume
Right.
or frequency trading.
Right.
That's you want something with higher liquidity and a tighter spread.
Yep.
Um,
Yeah, and it might have a higher internal cost, but if you're not in it for very long, it's not as big a deal.
Yeah,
Right?
and so that's where QQQM makes a little bit of difference. If you're like a buy and hold investor, that makes a little bit more sense. You're also, because of just how they're structured, QQQ is a little bit more expensive too. So if you're a buy and hold, that expense ratio actually makes a difference to you.
Yeah, yeah. They've both done fantastic. I mean, this has been the leaders of the world in a way that are on that 100 stock team there, and it's the greatest, companies out there to a large degree. So, obviously it just depends on what you're trying to do with it.
Yeah, I think for the average investor who's just a buy and looking to buy and hold over time, QQQM, it makes more sense.
Yeah, I agree.
And you'll see this difference between like SPY and then SPGL, or I think it was, what was it?
SPGL, I believe.
Yeah, SPLG. Yeah.
Oh, okay.
Yeah.
Yeah, the difference is the same thing. SPY is more tradable. It has a higher expense ratio, but people still use it a lot.
Yeah, if you're looking for option trading.
Big trading, yeah. And it's got a lot more, because sometimes you got like QQQM, they won't have nearly as many choices in the options market if that's what you're looking for as QQQ. So, yeah, again, depends on what you're trying to do with it. But it's a good question.
So, does the consumer price index account for shrinkflation? Because when we go to the store, we see like chip bags are getting slightly smaller. You're getting a little bit less for your dollar, even though the price looks the same. You're getting less.
Yeah, so let's say you're going to buy some Doritos bag 3 years ago, and you buy it for $1, and then you go to buy that bag now, it's still $1, right? But it's half as many chips inside the same size bag. And so the question is, does CPI, when they're doing the calculation, do they look at that and say, oh, it's still $1? There's been no inflation on that bag of Doritos. Or are they looking at the volume? So like how many ounces? And so apparently what they do is they break it down into units. So, cost per ounce, cost per piece, right? It depends on what it is. There's lots of things out there. So in the case of Doritos, it'd be probably the cost per ounce of actual chip and how much that thing weighs. So theoretically, that would have increased a 50% increase. So if you're still paying $1 for half as much chips, right, you've just had a 50% increase. So shrinkflation, because the reason this came up is somebody thought, well, maybe there's more inflation than really happening because they're not counting the shrinkflation, right? They're just counting the box of cake mix, which is apparently also getting smaller and smaller as we speak. So, so it was kind of interesting, to understand that shrinkflation is part of CPI, and they do a really good job with it actually, as far as that goes. So, they can't hide that. They can hide it from us as consumers because we're still, to a certain degree. I mean, it's gotten so ridiculous. I used the chip one because I bought this little bag of chips. I might have had 4 chips in it. It was the craziest thing I ever seen. So what they can hide it from us as consumers to a certain degree, and so that they don't end up having to pass along as much. But yeah, only so far you can go with that. Okay, good. That's a good question. What else do we have?
We're starting to see a spike in delinquencies for car loans. Is that kind of like the first sign of trouble for the market?
Well, actually, we had First Brands failed, right? Which was 17 billion in loans were outstanding. It's a auto parts manufacturing company. Looks like there might have been some fraud, right? 2.3 billion is missing apparently. That is probably more of a canary in the coal mine for me, just because it's big. Frauds tend to start cropping up when things fall apart, because a lot of frauds require money coming in to make up for the money that disappeared and got spent in the wrong spot. And so oftentimes when things start to slow down, and not surprising, it's auto, because auto's getting kind of really buffeted by this, a tariff situation, because they had another one of 50 million each for 2 different banks for a commercial property company down in Southern California. Western Alliance and one of the divisions of the Zion banks both got hit with this, and there was apparently some fraud potentially involved in that also. And so auto loans, they're not big enough on the overall scale to cause the 2008 downturn. If you've got a lot of these bigger loans, and this is what Jamie Dimon is talking about, that are out there that are maybe not fraudulent, those are just the things we see first, but just shouldn't have been lent to that organization because they can't pay it back, right? And you'll see his concern, and it's the same concern he had in 2008, is that even a small downturn in the economy could turn into something much bigger if there's a bunch more loans out there that we're not expecting. In 2008 it was credit default swaps, and so he's been talking about private credit, which is a lot harder to quantify, which is why it's dangerous.
Yeah, in private credit, it's harder to evaluate the assets because they're illiquid, and so it's a little bit harder.
Right.
And the magnitude of size for like the car loan market is, people are saying it's about a tenth of the size of the mortgage credit default mortgage swaps.
Yeah.
And so like you're looking at a much smaller market, and so even if there is going to be higher delinquencies there, it's not going to affect the broader market, especially as now as a population, the 10% of the population makes up 50% of the consumer spending.
Yeah.
The top percent, 10% are unlikely to be affected by these car loan issues.
That's right. That's what's driving the people that are defaulting on their car loans probably are not the people that are driving this economy right now, which is in that top 10% earner category. I will say this, though. The market's on a tear, right? It's just going. It's got great momentum. There's all kinds of reasons why, but there's a bunch of reasons why it could fall. And so, and this maybe isn't the biggest one, but it is additive, right? It keeps going. There's more and more and more little issues, and eventually the foundation of that run crumbles, and then that run finally comes down because of that, right?
Eventually something will tip the scale the other way, and
right. So,
but right now you see a major disconnect between Wall Street and the Main Street, you can kind of say. And
right.
A lot of people are feeling the hurt of the economy, while Wall Street's still flying up.
I guess I would see it as a portion of the early indication of what's going on. There's nothing wrong with that. I wouldn't be reacting to it, but it's just part of the additive components of, hey, what's going to happen with tariffs? What's going to happen in May when they can replace the Fed chairman? There's some big what ifs that are out there, combining with some of these other kind of headwinds that are starting to come up. Again, economy can go and go and go and be strong enough to weather all this, and maybe the growth slows down quite a bit, but still growing, right, and not shrinking, which is what happens with a recession. So, yeah, I think that's an interesting question.
So, what are the best ways to buy gold and silver?
Gold and silver. So they've had this historic run for both those metals. We talked about gold on one of the other shows, and just why it's running. But the central banks are buying gold and selling dollars. Dollars down, across the board, 10, 11%. For the first time in, I think, 20 to 30 years, central banks own more gold than dollars. So there's a reason for these things, and so people want to buy it. So you can do it a lot of different ways. You can. I think Costco is selling gold bars. I don't know if they still
Yeah,
are.
you can get gold.
Right.
You can buy at Costco. You can just go to a lot. There's a lot of jewelry or stuff like that. Or like
That's right. You can do coins, right? Because a lot of people do coins. Because they have a minted value, and you can collect them and such. And to me, that's fine for a hobby, but from pure investment standpoint, it's not super efficient. There's some danger of having them on hand, and maybe you got to keep them in a safe deposit box or whatever. In the investment world, you can use an exchange traded fund. In this particular case, they're buying actual gold and actual silver. So the gold is a spider gold ETF. The symbol is GLD. We own this in our portfolio now also. And so what happens with GLD is the Spider, State Street in this case, is a company that makes this. They have physical gold in vaults. And if you own shares of that ETF, you own a piece of that physical gold. And so they have vaults, I think it's in London, New York, and Zurich. And they have this whole auditing outside agency that comes in and looks at the purity of the gold, makes sure that the right amount is on hand. It gets audited every year. And so it's pretty cool. You directly own some gold. Now, you can't ask for it. You can't go, hey, send me my gold. But you have shares.
Yeah, they actually do allow you to get it, but you have to be an authorized participant, and you have to have 100,000 shares.
Ooh.
So it's not for your average Joe.
No.
Unfortunately.
Yeah, it's for some big transfers. Yeah, so that I think it's actually one of the coolest things made inside of an ETF is this ability to own a physical precious metal that is stored in a vault. Now, silver is just stored in London, and the one that we use is an iShares silver ETF, and the ticker symbol is SLV. Again, we have this in our portfolios also. And it's the same thing. You own a portion of physical silver, actual silver. The expense ratios on these are a little bit higher. Obviously, the standard deviation is, the risk or the vacillation of price can be, pretty extreme. So you got to keep this to a small component of your portfolio, in our opinion. You were telling me the other day, and because I remember 2008. Everything went down, including gold, bonds, everything. And what we've discovered afterwards was that they had to pay off all these credit default swaps, which were basically insurance policies on top of mortgages. Mortgage failed, they had to pay them off. They had to sell everything. And gold's just a storage of wealth. So if you need money, you're going to sell whatever you got.
You
that's
sell
worth
the bonds,
something.
you sell the gold,
Yeah.
you sell the stocks, whatever you have available to sell.
But then 2000, we saw gold go up, or at least hang in there, yeah.
Yeah, so it depending on what kind of downturn it is, gold can be something that kind of is a diversifier effect.
Yeah, I guess the hope would be that at least it's a delayed effect too, so that you have some chance to make some adjustments to it as the stock market's falling, if gold kind of hangs up there for a while before it falls, if it is going to fall. The weird part is that this particular upturn in the economy that we're in right now is both like the 2000, upturn and the 2008 upturn, and it could go either way. This could become a financial crisis because things get so overcooked, or it could just be hey, we've got to blow off the top because we've got tulip mania, which is what happened in 2000. And so, we're more like the 2000 upturn, in my opinion, than the 2008. So hopefully gold does well here. But
yeah, so I just looked up the numbers. Gold was down 8%.
Yeah.
While, the .com stocks were, NASDAQ was down 78%.
Yeah.
And so it was definitely down, but it was definitely a good diversifier.
Yeah, it was a bit of a parachute. Yep. Yep, that's a good question. All right.
So, with so much front running in the market, should you be trading whenever we see large, suspicious activity or unusual activity?
So what he's talking about with front running is where somebody seems to have knowledge of what's going to happen soon in the future, which
Mhm.
is, we saw that when the announcement about increasing the tariffs on China, a couple of hours before that, some large trades were placed, and shorting cryptocurrencies,
Mhm.
and somebody made $160 million very quickly. So you look at that right before the announcement. So that would be front running. They're front running that information and making a profit off of it. That's been going on a lot. It's crazy how many things, you look at like how much activity happens before announcements. Look back at April. So it's not a secret that these are coming to everybody.
Mhm.
And so should you try to find those and join that group, right? And get involved with that. And so what was it, yesterday? Somebody moved $3 million to short cryptocurrency based on Trump's 3 o'clock announcement. And they shorted it at 40 times leverage. So if they were right, it was going to be a big payoff. It turned out to not be really anything.
Yeah, it was pretty much a nothing burger.
Right. So, obviously that person didn't know. They thought they would know and hoped that they know, but you can't tell the difference if you're chasing after somebody you think has the right info, and it turns out that they're just guessing like you are. So, I don't. We obviously would never do that here. It's just not something that we do. Although it's probably pretty popular.
It's super hard because you have to be constantly watching. You have to be
Yeah.
watching different markets, seeing what's going on, just volume. It, it's you need some sort of alert system or some sort of systematic way to do it. Otherwise, you're gonna be your eyes attached to that screen 24/7. Because the market never closes, especially with crypto.
If I was a trader, I'd be trying to figure it out. Why not? It's just part of a diversified portfolio strategy. Part of it could be trying to chase these front runners with a piece of your portfolio, but that's a full-time job, right? Which is fine. A lot of people do this as a full-time job, or close to it, and so I don't have any real problems with it or trying to do it. It's not something we would do. It's kind of interesting. I just wish it wasn't there because that's not how the market's supposed to work. So. It's kind of sad. And you see all these people in Congress who are front running all the time. I mean, gosh, they buy these stocks and then a big contract's announced, 6 weeks later. And
Yeah, because you can
a
make
government contract that they knew about because they were on the committee.
Yeah, because with the current law, you can, as long as you report it within 45 days of the purchase, you're in the clear. So you could, so there's a lot of interesting ETFs now that follow
Politicians.
politicians.
That's
I
right.
think the Democratic one is NANC for
Nancy.
Nancy, and then I think the GOP one is it used to be KRUZ for Cruz,
Oh.
but it got changed to GOP.
Okay. Interesting.
Yeah. So you can do that. There's a lot of sites that actually just like have each kind of portfolio for each of these congressmen and women, and you can, if you want to follow someone, you could probably have some sort of investment that would be like them, but you're always going to be behind them. You have to remember that.
Yeah, you're not going to get the same. Well, who knows? I mean, sometimes me behind works. They get in a little early and there's a dip, and you get in later with a better
Yeah.
price. But yeah, in general, you're not going to be in front of that news because it takes 45 days for
Yeah.
them to report. So yeah, but some of these guys walk out of Congress with some pretty hefty, net worth. So it's kind of
Much more
fascinating.
than the salary would.
Yeah, no
They
kidding.
made off the salary.
Much more than the salary. Which is why they shouldn't allow it, right? I don't know why. There's so many things that happen that shouldn't be happening. Just, change the rules. But the people that are profiting from it are the ones in charge of changing the rules. So
Yeah.
it makes it difficult. Okay, good. What else? Maybe one more.
So how does an extended government shutdown affect the market? We're coming on 22-ish days or 23 days for the shutdown. It's the second longest shutdown in history. If it goes to November or extends a little bit longer, what are we going to see as ramifications of it?
Yeah, well, we think back, of course, the last time we had a big one, the market was doing okay, but the Fed was lowering rates at the time too, like they're doing now, and we ended up with a 10.3% return on the S&P during that 35 days. The market was closed. There's a lot of casualties in a shutdown. I mean, people are losing their jobs because they're using it as an excuse to slim down the size of the government. The stock market may not be one of those casualties. If you look at what happens, if I'm working for FAA and I'm not getting paid, that's a big deal. I don't know how I pay my bills, and you hear these stories about them doing Uber at night or whatever.
Yeah, they're going to food banks.
Yeah, but how, what impact does that have on the stock market, especially because stock market's pretty much dominated by these really big companies. They're running into a few issues like anybody would when things are closed, but it's much more of an inconvenience for those of us. My daughter actually has an appointment to change her name today at the Social Security Department, and we were wondering if that was even going to happen. We'll find out when we talk to her later. But so those types of things that are out there and things that need to be done.
Yeah, they're
questions
also
you might have.
adding just more people back into the critical for at least Medicare because of open enrollment. They're adding at least another 3,000 employees.
Yeah.
So I think for services, they'll keep what's functioning, but it just sucks for a lot of people. Military's not getting paid. Federal workers, having to be
trying to do the military, at least for a while here. I don't know that they'll be able to do it for an extended time.
Yeah, it just sucks that there's casualties around for what people Democrats believe is right, and then what Republicans believe is right too.
Yeah, I mean, you're exactly right. I mean, national parks are probably going to take a hit here because they're not being supervised at the same level. It could be some destruction that happens, that kind of things that might not happen if it wasn't a shutdown. But again, what part of all of those stories and all of those miseries add up to a smaller stock market? There's some components. That's a group of people that's not spending money.
Yeah, they're not
right?
traveling, so maybe hotels and airlines
they don't
are
have
hurting.
revenue coming in. They're spending less, even if they're spending their savings than they probably would have if they were still employed. But they, at least in the past, they have paid them their back pay. So, 35 days with no money going to a subset of federal employees is an impact, but it's not a big enough impact to really have an impact on the stock market. Bigger impact in other areas, but looking at the market itself, and especially because they get their money 35 days later or whatever, shortly thereafter, and that money comes into the economy anyway. So the market's already seeing that. It's I think if we thought the close down was going to be 3 years long or some crazy thing, the market would probably be reacting quite negatively. But looking at the longest one being 35 days, we can get through 35 days with this particular economy or longer. Probably get through months. At least from the economy standpoint and at least from the stock market standpoint. So I don't think it has a big impact. It has a bigger impact in other areas than it does the stock market. Lots of other areas. Okay, that's good today. Look forward to being able to see you again next week. Again, we'll do the daily videos Monday through Thursday, and then we'll have this show, do the summary for the stock market, and we can answer your questions. So send them in. Ask Tom at talkmoneywithtom.com. Let us know, what you'd like us to cover in the show next week. And of course, you can subscribe to our channel, hit the bell button if you'd like to get notified when new stuff comes out. Or if you'd just like to meet with Ethan and I, feel free to do that also. We have a book appointment button right up in the corner there on our website. There's a link to the website here on the channel, and set up a 30-minute time to talk with us and ask us questions directly. So anyway, look forward to being able to see you again next week. Thank you very much.